Hi everybody, my name's Griffin Bridgers. This is a continuation of the basics of generation skipping transfer tax. In this part 7, we're going to dive into some fundamental knowledge you need to know in order to understand the next topic coming, which is taxable terminations and taxable distributions. This kind of shoehorns in well to our previous discussions on indirect skips. So what are we going to cover today? What's going to be the applicable rate for generation skipping transfer tax purposes, and the inclusion ratio. So before we get started, I want to remind you again that this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So having laid that groundwork, last time, in the last two parts, Part 6 is supplemented by Part 6A, we talked about indirect skips and GST potential, really in the context of trusts and with a sprinkling in of Form 709, the U.S. gift and generation skipping transfer tax return, as a prelude or introduction to the concept of what we do with the GST exemption and the allocation of it. However, what this has glossed over so far, I think, is the ultimate planning goal of indirect skips and allocation, which is locking in an inclusion ratio and thus an applicable rate. So we're going to turn our attention to this goal with indirect skips. Now, before we get started, I want to bring in kind of a layered example from last time. So we closed out last time with the concept that we have a grantor who's a parent who creates a trust for their living children and for future descendants. Now, at the time of the transfer, no grandchildren, i.e. skip persons, are living yet. However, the term descendants under the trust and under state law includes future born descendants. So what this means is that no skip persons are alive yet, but when each grandchild is born, they instantly become both a beneficiary of the trust and a skip person. So what do we do here? What's our goal? What's our outcome? We're going to assume numerically we have just 6 million transferred to this trust. So if you're a numbers person, that helps bring this from abstract to more concrete, but we have a lot of ground to cover before we look at what do we do here, which will hopefully help aid your understanding of a couple concepts. Now, I want to just give you a quick refresher because it's been a while since we touched on direct versus indirect skips. And the macro theme, when we compare the two, is timing of the application of the GST tax and GST exemption allocation. And that comes into play when comparing direct skips to indirect skips. So with both an indirect skip and a direct skip, there's always an immediate application of the GST exemption at the time that the transfer is deemed to be complete for federal gift tax purposes if it's a lifetime transfer, or for federal estate tax purposes if it's a transfer at death. However, the GST tax for a direct skip is always immediately determinable when that direct skip transfer is completed. So there is an allocation of GST exemption to that transfer, but it essentially applies once and is wiped out and goes away forever. However, with an indirect skip, there's never a GST tax when the transfer is completed, typically to a trust. Instead, the GST tax, as I briefly mentioned in the last part, is deferred until a later event, which we'll come to know as a taxable termination or a taxable distribution. Now, I promised to cover those in the next part, but I realized it helps to continue to table those and actually provide some examples later on to segue into that discussion, which will be very short. But that being said, to understand those types of transfers, we have to understand the GST consequences of those types of transfers. So, even though the GST tax is deferred on an indirect skip, we do have a singular goal here, which is locking in what we'll come to know is the GST tax rate that will apply to future generation skipping transfers that might happen from that trust if and when skip persons both become a beneficiary of the trust and receive benefits from that trust. So going back to our example, we had the $6 million transferred to the trust. And although there's no skip persons, we still have to consider that concept I introduced last time, GST potential, the possibility that skip persons who are included in that beneficiary class of descendants of the grantor will be born at some point in the future, potentially. So let's assume we put in $6 million initially, and then the trust grows maybe, let's say, to $50 million at the time that all of the children of the grantor die, leaving only grandchildren and more remote descendants as beneficiaries. We're going to assume the children were fruitful, produced descendants between the $6 million point and the $50 million valuation point. And once the children die, i.e. generation 2, the only remaining beneficiaries at that point would be skip persons. So what happens now? Well, generally, this is what we'll come to know as a taxable termination. And at this point, we're going to find out that the trustee has to pay GST tax out of the trust at the applicable rate. So what is the applicable rate? Well, as we're going to find, there's a rabbit hole here, and the applicable rate is going to relate back to events that happened at the point where we put $6 million into the trust. So what is the applicable rate? Well, this is defined in Code Section 2641A as the product of the maximum federal estate tax rate and the inclusion ratio with respect to the transfer. So we have to determine two things: maximum federal estate tax rate and inclusion ratio with respect to the transfer. The question is, which maximum federal tax rate applies? Well, we go on to look at Code Section 2641B, which defines it as the rate that applies at the time of a taxable termination, taxable distribution, or direct skip. So recall how we deferred the GST tax on this indirect skip until some future event, a taxable termination or a taxable distribution. Well, note what happens here. Right now, when the $6 million goes in, if it goes in right now, it's the federal estate tax rate is 40%. That's the max rate. However, that rate could be increased by Congress in the future. So the risk you run here is that down the road, the GST tax could be based on a rate that is much higher that is changed by Congress. It's been as high as, I think, even 70% before. If you're a historian in estate tax and I have that wrong, I apologize. Don't quote me on that. Don't correct me. I just throw that in as an example. But while the federal estate tax rate can be fluid, there is one constant we're going to find out here, and that is the inclusion ratio. And it takes the bite out of any change to the federal estate tax. So when is the inclusion ratio defined? Well, in Code Section 2642, it defines the inclusion ratio first and foremost as the excess of 1 over an applicable fraction determined at the time of transfer. So if you're thinking mathematically, you can envision that this might be a 1 minus 1 or 0 type of outcome, which we're going to find out is our ideal outcome. But diving into the implications of this and the timing, with a direct skip, that means that the inclusion ratio is determined when that direct skip transfer is completed, but then immediately goes away. But for an indirect skip, this means that this inclusion ratio is locked in at the time that the transfer is completed for federal gift or estate tax purposes. We'll get into estate tax later because things are defined a little bit differently there. We're really focusing on federal gift tax for indirect skips by definition. But either way, this means that the inclusion ratio, if the federal estate tax rate changes and if there's a later GST tax transfer event like we talked about, that inclusion ratio will always relate back to the time of the last federal gift or estate tax transfer relating to that trust. So what is the applicable fraction? Because recall, the inclusion ratio is 1 minus an applicable fraction. And I know I'm layering in a bunch of terms for you here, but bear with me. This is the last one we really have to worry about today. Code Section 2642A2 creates a formula for the applicable fraction, which I'm going to kind of paraphrase here. One, with any fraction, you have a numerator, the top number, and a denominator, the bottom number. The numerator is going to be the GST exemption allocated to the trust. I put trust in quotes because that's how the statute reads. And this implies really that an indirect skip will practically always be a trust transfer. So I sometimes get questions of when do you have an indirect skip other than in a trust? And that's a discussion for another time. But the bottom number, the denominator, will be the value of property transferred to the trust reduced by the following. One is the federal estate tax or state death tax that's recovered from the trust that's attributable to the property involved in the generation skipping transfer. And then next, we reduce it by any charitable gift or estate tax deduction allowed. Now, why might not we reduce by marital deduction? That's another topic for later as well. So the big question here is value, and that's another topic we're going to have to table, but generally it's going to be the value finally determined for federal gift or estate tax purposes. Now, if you do your homework, if you're curious, and you dig into Code Section 2642, you're going to see a twist under the gift tax value, because the gift tax chapter is Chapter 12, or Subchapter 12, I should say, within the code. But there's a twist here. It acknowledges that this value may be determined after death under Code Section 2001 F2. Why? Well, as we're going to find out later, and we've kind of alluded to before, automatic allocation of GST exemption may not require the actual filing of a gift tax return. And these are two different tax regimes. If you never pay your gift tax or allocate applicable credit, there may be some relation back and some reassessing that has to happen on your estate tax return at the time you die. And in such a case, the IRS can go back and determine federal gift tax value after death. So the federal gift tax value, as finally determined, as we're going to find out, can relate back to the date of gift, and thus the GST automatic exemption allocation can relate back to that point as well. But that's splitting hairs. That kind of confuses tangentially from what we've talked about, which is the applicable fraction. So to bring things home a little bit, perhaps overly simplified, the applicable rate will be the maximum federal estate tax rate times the inclusion ratio. So for example, right now it's 40%. That means that our applicable rate will be 40% times the inclusion ratio, subject to future congressional action, which could potentially change that rate up or down. We never know. And that's a common theme you see through the code for estate and gift tax purposes too, that it's built to react to changes in tax rate, which is why I think it's important to kind of know the federal gift and estate taxes before diving into this specific subject matter. But that aside, that's our applicable rate. The inclusion ratio is 1 minus the applicable fraction. And the applicable fraction is numerator, GST exemption allocated to the transfer, whether automatic or manually, over the value net of estate tax and charitable deduction of the transfer itself. So bringing this home back to our example, in an ideal world, what we do is we'd allocate $6 million of GST exemption to the transfer to our trust in the example at the time of the transfer, either actively through our gift tax return, where we manually allocate GST exemption, or passively, regardless of whether a gift tax return is filed, by relying on automatic allocation. So this is kind of foolproof. What we'll find out is the automatic allocation is designed to keep you from goofing and keep the GST tax from applying unintentionally. So this creates an applicable fraction of essentially 6 million over 6 million, or 1. This is a perfect 1-to-1 ratio, 1-to-1 fraction. As you recall, any number over itself in math creates or is simplified to 1. And that means that our inclusion ratio is 1 minus the applicable fraction, or here is 1 minus 1, essentially, after you simplify 6 million over 6 million down to 1. Or 0, in other words, for the inclusion ratio, which I've alluded to so far. That amount is locked in until trust property is later subject to gift or estate tax, which I want to clarify here. What you're locking in at the time of transfer is the inclusion ratio. The rate can be fluid, but the inclusion ratio will always keep the applicable rate at 0 as long as that inclusion ratio is locked in through the transferor of the property remaining constant. So what this does is it creates an applicable rate of 0, because we're going to have our max federal estate tax rate times the inclusion ratio, which is 0, which essentially means we're always going to have 0. So this creates what's known as a GST exempt trust, but it's technically not exempt. There's still a GST tax in the event of two events from our example trust in the future, which to segue into our next discussion, I'm going to give you an example of to table for part 8. We're going to assume, again, the trust grows to 50 million, all of generation 2 dies, which is a taxable termination, hint, hint. Let's assume down the road, when this 50 million of growth has happened, that the federal estate tax rate has now increased to 55%. So technically, by the terms of the GST tax provisions, that 50 million is subject to GST tax at this time. But the applicable rate is 0% because we locked in a zero inclusion ratio up front when we put 6 million into that trust. And let's assume maybe while generation 2 is living, the trustee makes a $2 million distribution to a grandchild from the principal of the trust, which is, what we're going to find out is a taxable distribution. What we're going to find out later is that the grandchild owes GST tax on that distributed amount under the technical letter of the GST tax laws. However, the applicable rate is going to be 0% because we locked in a zero inclusion ratio when we put 6 million into this trust. Thus, here is the illustration of our ultimate outcome and goal. Now, a bonus I want to mention, if you're into theory and putting pieces together, I put an asterisk on the netting of federal estate tax when we talked about the applicable fraction, which raises an interesting point on value to close the loop, showing the difference between gift and estate taxes. So, as you recall, for a generation skipping transfer during the transferor's life, the value of the transfer is actually increased by and this is wrong a little bit, but it's the gift tax value is increased by GST tax paid out of pocket. So I've got a bit of a typo here. Thought I was being clever. I apologize for that. But you get the general gist. However, for a generation skipping transfer after the transferor's death, the value of the transfer will be decreased by the estate tax that's paid out of the transferred property. So apologize for that goof. I'll throw this corrected slide in a future part because, like with any video, I try to do this in one take. But with that being said, more is to come. I'll finally cover taxable determinations and distributions definitionally in the next part, but with a deeper dive into who owes the tax and who reports it in that type of a situation and how is it reported. We'll also dive into making GST exemption allocations on 709, which we briefly introduced before, but get into more of the strategy on manual versus automatic allocation. Also, we have to look at some of the exceptions, the definition of GST trust, which makes it impossible to have an automatic allocation, and also the definition of an estate tax inclusion period, or ETIP, which makes it impossible to have automatic or manual allocation until that ETIP period ends. Then finally, we'll get into the GST tax annual exclusion and some of the direct payment exceptions for tuition and medical expenses and how they might be affected by lifetime indirect skips and traditional crummy powers. And then finally, another topic that was introduced here briefly, valuation. So in our glossary of terms so far for review, we've added 3 more. We have applicable rate, applicable fraction, and inclusion ratio. So if nothing else, you need to know what those are as your learning objective for today's Part 7. Thank you again for joining me for this Part 7 of the Basics of GST Tax. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com with the caveat that I cannot give tax or legal advice in response to your questions. But I thank you again for joining me for this video presentation, and I look forward to seeing you in my future content.